So we got a little bit of a workshop for you today. We're going to do this on the banking system. How does it work? Why does it work? Well, what's it supposed to be doing, and what's really happening? So if you're watching us on ronsiegelradio.tv, any of our socials, or the ABC News and Talk AM 1490 video feed, you may actually be able to see some of these things going on, what we've got in mind for you right here about the banking system. So let's get on the roll. So how does the banking system work? Basically, here's what it is. You say, or a company deposits $100,000 into the bank. Bank holds $10,000, 10% in their reserves, and they need to make money with the other $90,000. 0.5% on $100,000 if they're giving that to you for your deposit. You put that money into your savings, they're giving you 0.5%. They're paying you $500 a year in interest. 2% on $90,000. That was what they were lending the money out at. That's what they netted out after all the costs when they were either putting it into treasuries or they were lending it to borrowers for home loans. Remember when we had loans, interest rates at 3%? Well, the bank actually out of that 3% may say they get 2%. So they're going to make $1,800 a year in interest, which is $1,300 net. Makes sense right there, right? Because that's how they make their money. They keep some, they lend some, and make money. Moving right along, how do the banks make money? They can lend in a safe short-term assets, business loans, car loans, home equity lines of credit. They can invest, example, in mortgage-backed securities. An example, a 3% mortgage rate equals a 2% coupon. Today, that 2% coupon investment is not worth what it was before because interest is higher. Interest rates go up, the bond value drops. It's a mathematical teeter-totter, seesaw, whatever you refer to them as. But under that, you don't have that to show that under the hold to maturity is what they called it in Dodd-Frank. You don't have to show that loss against the capital because Dodd-Frank actually said if you hold it to maturity, you're going to get your money back. Banks are not forced then to say, okay, that item that we have on our books at, say, $2 is worth $1. That would mean they'd have to show $1 loss. Not good, because they figure that after that mortgage-backed security matures or is refinanced, home is sold or the bond matures, the bank's going to get all their money back. So they don't have to show that negative equity on their balance sheet under their Tier 1 capital. Now, what happened because of the Fed's reckless actions? Well, remember the banks loan and invest have a fixed rate of return for a period of time. That's why a 30-year loan, we could say, a year ago or a year and a half ago, 3% was what you were going to pay for it. Banks were going to collect 2% of that. The other goes into the expenses and the servicing companies and whatnot. So say it was that they got a 2% mortgage bond. That's what the bank was holding, was that mortgage bond. But that starts to rise because depositors start to see that they can get more money somewhere else. So they start saying, okay, the net interest margin is not good. It's not what we want. The big banks then realize, okay, the borrower is going to cash in that bond. And when they cash in that bond, their borrower is taking a loss. The bank is taking a loss on that because they're not going to, they can't keep getting the same amount of money. And the borrowers want their money back, right? They want whatever the portion is that they're entitled to. They may not be able to get all of it, but they're going to get a portion of that back. Remember, the bank was only keeping on reserve 10%. That's where that whole issue comes from. So if the bank's only holding 10% and you get a bunch of people wanting their money back, which is what happened with Silicon Valley Bank, well, now they've got to start selling those bonds to give people their cash. Well, okay. Remember, there's a better place to put that money than leaving it there, getting that 0.5%. They're looking and saying, I can go to a U.S. Treasury and get 4% or 3.5%, whatever I told you it was just a little bit ago. Right? So here's the issue. They take their money out of that. Silicon Valley Bank doesn't have enough money. So what are they going to do? They have to start selling the bonds. The bonds show a loss. Now, Silicon Valley Bank had reserves, I think, of about $12 billion, and they would have shown a $15 billion loss. I'll get to that more in a minute. But they had no risk management officer for 8 months, arguably some of the toughest times in the banking industry because the Federal Reserve was increasing interest rates at an unprecedented level, April 29th to January 4th. Gregory Becker, though, the CEO of Silicon Valley Bank, is a board member of the San Francisco Fed. Little conflict of interest there, maybe? But what does he do? Well, he realizes what's going on a couple weeks ago before this happens, and he's selling his stock because he knows about the balance sheet issues. The current chief administrative officer was the CFO for Lehman Brothers. Do you remember Lehman Brothers? The balance sheet showed again, so another problematic area there. Balance sheet showed $12 billion under the shelter of 2008 ruling, did not count unrealized $15 billion of loss due to held to maturity calculation. If they had mark to market, they were not 12 billion good, they were 3 billion in the red. Think about that. That's again another problem. Now, let's take it one step further and bring in the media. Think about that one. So we've got the media here. They're going on the next step. Okay, let's think about this one. February 8th, Wall Street is mistakenly concerned about SVB. Fears are not justified. This is on Cramer, the Jim Cramer show on CNBC. And I quote, Wall Street is mistakenly concerned about SVB. Fears are not justified. He's saying the stock is still cheap. A $320 share with room to run is what Cramer said. $320 a share, room to run. So Cramer brings this whole thing out into the limelight. That's where the issue comes up with this. Unbelievable. Savvy investors take notice of what's going on here, and they do some digging, and they realize Cramer doesn't know what he's talking about. Think about that. So they realize this. They start shorting the stock. Now, what does that mean? Let's before actually I got a little ahead of myself there. So savvy investors notice the cracks in the Silicon Valley Bank. They realize there's something called duration mismatch. It's that hidden $15 billion in unrealized losses. The investors start shorting the stock. That's drawing more attention to it. What does shorting the stock means? Well, investors not only don't they listen to Cramer, they do the exact opposite. They start going out and betting that the stock is going to go south, that the stock is going to go down. That's where the investors are saying. So they get a run on the stock price. Investors now notice that the remaining $13 billion in unrealized loss on the remaining $60 billion in agency securities, that tells the investors the bank is bankrupt. The bank is insolvent. That's the issue right there. So the short sellers, they smell blood. The stock craters. Depositors warned to get out. See that? When the stock starts going down like that, the depositors say, you know something? This is a bankrupt company. I want my money before they go bankrupt. Remember at this point in time that the FDIC was saying money's insured to $250,000. But there's payroll accounts there. Some of the payroll accounts have significantly more than $250,000 in them. 93% of the money that's held at Silicon Valley Bank, 93% is outside the FDIC insurance. Think about that part of it. That's where the problem is. So with that being outside of that insurance, people are starting to pull money out. The number I heard, I may or may not be correct, is $500,000 or $500,000 per second was being pulled out of the bank. $500,000 per second being pulled out of the bank. Because remember, in prior banking issues, whenever we had a bank run, it's called a run on the bank, when this happened, people had to line up to get their money. Do you have to line up to get your money at a bank now? No. All you have to do is go online and you can actually get your money, right? And all at this same time, Janet Yellen, she's saying the banking sector is resilient. And on Sunday, this is a week ago, she says there's no shot at a bailout. Thanks, Janet Yellen. On Monday, the Fed steps in. The Fed and the FDIC protects depositors, thank goodness. Bank Term Funding Program, BTFP, allows banks to trade underwater securities, and the Fed will buy them at face value. So the Federal Reserve is buying them. The Federal Reserve went from, and I don't have the exact numbers in front of me, but they went from basically the week before the bailout or this run on the bank, they had about $6 billion requested at the Fed discount window. This particular week, which was last week, over $150 billion. Almost, what is that, 25 times the amount? So we got a bailout there. You can call it whatever you want, but it is a bailout. What does this mean for us? Well, we've got a flight to safety. People are saying, okay, I'm going to get my money out of any of these banks that are smaller banks that we have to worry about. The institutions have to rethink their reckless policy. Now we're going to another version of quantitative easing. So the Federal Reserve says they're going to raise rates, yet which is slowing inflation, but they're going to buy the bonds, which helps increase inflation. And it's all because they wouldn't look at what's plain and simple. We've been talking about this. It's the importance of the inverted yield curve. We've been talking that it always causes a recession. Nothing has changed. These issues are all deflationary. So the banking issues, why is that deflationary? Well, the reason is because the banks are starting to say, you know something, if we have to be giving people their money back, we don't know what we have to lend out. So they start making their guidelines tighter on the lending side. Maybe not as much for mortgages because we've got Freddie Mac and Fannie Mae, but it might on some of the non-qualified mortgages where the bank statement, we may see some of those getting a little bit tighter. But because there's less money going into the system, well, that helps bring down the inflation rate. But the Federal Reserve keeps looking backwards instead of trying to project and forecast what's happening in the future. So I hope that helps you understand a little bit where we're at with this. The bottom line with all of this is that we're going to have some issues here. Because of all of this, there's going to be a flight to safety. What does a flight to safety mean? That's why the U.S. 10-year Treasury earlier this morning had dropped so far. It's because there were folks out there looking and saying, you know something? If we don't understand what the banking system has to offer, if we don't know that our money is going to be safe, what are we going to do with our money? Pretty simple. We're going to put it into what's the idea generally accepted as the safest investment in the market. That would be U.S. Treasuries. And that's why we saw the yield this morning on the U.S. Treasuries had jumped so much. It was so much further than what we had seen. I mean, right now I told you that the bond is up 4 basis points. It is at, I don't know why my chart won't populate right here so I can actually give you the exact number here. But right now we're looking at the bond at 3.466. Earlier today it was at 3.39. So it was down significantly lower than where we are seeing it right now. And that all has to do with that flight to safety. You're listening to Ron Siegel Radio.